Good afternoon. This is the Bob Unger Show, and we have a real treat for those of you with a functioning mental status. That might be a select few these days, but certainly doesn't include politicians or any of the people that are running this world. But it certainly does include our guest. His name is David Haggith, Haggith, and he writes the Great Recession blog, and he's been writing it for quite a while. And if you take a look at his articles, which he'll tell you later how to access, you'll see that he's been pretty much on the money. I mean, nobody gets it perfect, but the problem is that you guys out there, you need to subscribe and you need to actually spend time reading it, because David does a deep dive. He doesn't just speak superficially like these idiots like Janet Yellen, and goes deep down. You wanted to say something, David?
No.
Oh, okay. Because Janet Yellen, the only thing she's qualified to do is make latkes during Hanukkah. That's about it. So, Dave, we're going to talk about the banking crisis, and we need to stay fairly basic here so that people can understand why this all happened and why this was really 100% predictable.
Mm-hmm.
Even though you're a genius, as we all know, the fact of the matter is that it did not take rocket science to see that when these banks are stocking up on bonds and then interest rates are going to rise, that naturally the value of the bonds would go down, thereby rendering a lot of these banks insolvent. And you probably saw in the headlines that the Blackstone Group, their real estate portfolio, commercial, which includes residential homes because they buy them to rent them out,
is going
of a net negative equity. Blackstone, the geniuses of the world.
Yeah, geniuses.
So, Dave,
they're defaulting on loans.
How did we get to where we are, and will take us through the whole process?
Well, let's start with where you just were, and it doesn't take a genius. I'm not a genius. I'm by any means. It's really straightforward, and that's what's so frustrating about this. I write these things and I make predictions about them because it's like adding 2 + 2 = 4, except that everybody around me says, no, it's 7, it's 5, it's 3. And you just wonder, how do they come up with this? And so you take your opening statement there that, well, everybody should know that if bonds are going up in yield, they're going down in value, down in price. I mean, if you don't know a lot about bonds, you don't know that, but it's inexcusable for a banker or the Federal Reserve to not know that. They deal in bonds all the time, every day, and that's what bonds always do. It's an inevitable thing. I mean, it's just math. And so, without going into the details of it, so of course they had to know that was going to happen, and yet they weren't prepared for it. That's almost inconceivable, except that they do these dumb things so often, it's now, in my view, expected. So I actually wind up predicting they will do it, because you just look at their pattern of mistakes and say, okay, they're going to do this again. If you I know I watched the Senate hearing yesterday, which was a joke, where the inquisitors in the Senate went after the regulators. So you got the overseers who are trying to oversee the overseers of the financial system, and they're all just looking for someone else to blame, because there's no excuse for anybody sitting in that panel to not have seen this coming too. And yet they let the Fed continue to be in charge year after year, no matter how many mistakes it makes. So, but some of them did ask that same astute question. They said, well, one guy said, look, I've been a venture capitalist for years. This is banking 101. If you, the Fed, are raising interest rates on bonds, then the value of those bonds is going to go down. So how is it that these banks didn't know banking 101 And how is it as you, the regulators, weren't watching out for this problem? Because you're raising interest rates. There are some banks that have huge amounts of these bonds that are going to be devalued, therefore, and those are in their reserves, which means their reserves are coming down in value. So why weren't you watching for this? And you just watched them all look to blame the other guy. The head of the Fed and the FDIC basically both pointed to the bankers and said, well, those guys screwed up. And one person said, well, yeah, but wasn't it your job to watch the bankers? Well, we did. We reported to them that this problem was coming. Oh, well, when did you report that? Well, we reported that back in November of 21. Let them know and put them on notice that, they needed to do something about this. And, the guy's incredulous and he's like, well, you put them on notice. That was November of 21. We're in 23 when this blows up. At what point do you drop the hammer? And instead of just putting them on notice, say, we're going to make this really painful for you guys in order to get you to do what you need to do to change your position. But, the regulators, I think they spend so much time fraternizing with the people in the banks, because many of them work right inside the banks they regulate, that, they don't want to blow up good friendships. They're going to go out and have beer with these guys after work or something. So I don't know. How else do you explain why they didn't look at this that's so obvious and say, you got to convert this stuff on your balance sheet long before the Fed even starts raising rates? We know they're going to, so start converting it now while the value's there and you won't lose anything.
Yeah, well, let's go through the steps. Why did it happen now as opposed to 4 months ago?
Well, I think, if you devalue something 1%, it's not going to hurt you. 2%, it's not going to hurt you. Sooner or later, you get to this point where it's the straw that breaks the camel's back, and you get enough percentage points down that the problems start to show up. And it's like Warren Buffett has said, when the tide goes out, you're going to find out who's swimming without a swimsuit. Well, the tide's going out. And of course, the weakest hands are going to be revealed first. So the people who are most overstuffed with this and in the most precarious position are the first ones to go down. So we've reached that point where the tide's now come down enough that we're starting to see a few people don't have swim trunks on. And those who stand tallest in the bad department are showing up. And, that's the way it's going to happen. And then as the tide goes down more and because interest rates are going up more and bond values are going down more, it could get worse. Now, the Fed has stepped in with a rescue program to turn all those bonds over at face value. So they may have stopped that problem, but we don't know what problems they've already set up. How many non-banks are in trouble because of this? They're not going to run out and tell us. They're still trying to duck low in the water and pretend like they got their swim shorts on or find them in a hurry. But we're going to find out more problems are coming. This is just what emerged practically overnight.
Explain to us what fractional reserve banking is, and also what zero reserve banking is, which is what we have now practically.
Well, fractional reserve banking is based on the idea that if a bank has, say, $100,000, just to use a really simple, easy number, that's in their reserves, then they can create loans up to $700,000, say, or whatever the Federal Reserve sets as their reserve ratio for the loans they create. And this is really where the money in the system gets created, not so much by the Fed. The Fed raises reserves, but it's the banks that really go out there and put it in circulation. And they do that by creating loans. And they create those loans out of nothing. They don't have to have money in the bank in the amount of that loan. If they want to write out a loan for X amount, they can do it, so long as their total of loans that they're still holding doesn't go above whatever their fractional reserve, whatever the fractional reserve ratio is that the Fed has set for banks. So they over leverage all this money. They don't have as much money in reserves as they've taken in a deposit. So the banks effectively borrowing the $100,000 from you that you deposit into the bank, and then they're loaning out $700,000 on that deposit. Well, if you come along and you want your money back, all of a sudden there are zero reserves to cover that $700,000 of loans that they've issued out there, because that's what they no longer have what they needed to back their loan. So they're in trouble.
Well, there used to be a time where the dollar was at least partially backed by gold, which is why they took us off the international gold standard with Nixon, because the foreigners were realizing, I don't want to own these treasuries because I may be buying a debtor who is not reliable. And it's interesting that the treasury buying, which are the bonds issued by the government, which in effect is a loan to the government, that had been dying out in terms of foreign countries. And by doing this, they actually forced people into bonds, because a lot of people were running the heck out of the bank with their cash and then buying these bonds, which of course would cause the interest rates to go down, because the more in demand a bond becomes, the lower the rates have to be. The less in demand, the higher the rates have to be. So number one, they were getting people to lend money to them, which wouldn't have happened if they didn't cause the bank runs that were going on. And in addition to that, they caused people to take their money out of the smaller banks, which really aren't so small, and then give them, everyone was putting their money in Chase or Citicorp or, any of the really big banks. So it was almost as if the feds were in cahoots with these big banks, because a lot of deposits went into these banks. And maybe these big banks are not as sound as the so-called analysts and the so-called regulators claim them to be. What say you about that?
Now, when you talk about that flight of capital to banks, were you talking about that happening back in the Nixon era, or the flight
No,
that's
no, I'm
happening right now?
talking about now, how they favor to the big banks by allowing them to consolidate all these assets.
Well, and there, you scratch your head and you wonder, are these guys that dumb that they didn't see that their program was going to inevitably do that? I mean, if you take and you say, well, we're going to insure only the big banks up to sky is the limit, but none of the other banks, well, then of course all the big accounts are going to leave the other banks, and if they lose their big accounts, they don't have enough to run with anymore. So you're creating a run instead of solving a problem of runs. So that exacerbated the situation. I don't know how they didn't see that. I mean, if one was going to be charitable, you'd say, well, they did all this, in the overnight to rescue banks in emergency, and they didn't have time to think it through. But they've had time to think it through now, and they still haven't changed that. It's obviously creating a situation where there's a vacuum sucking money towards the big banks where the big protection is. I mean, why would you choose to keep your money at local community bank when it's going to be uninsured? Let's say you're, a small business, you got a $1 million account that you use to do payrolls. $1 million isn't small to me, but if you're a business, that's not a large size business. You got $1 million in the bank that you use as operating funds we're talking about. So you roll through that every month. $1 million comes in, $1 million goes out. But are you going to keep it someplace that's uninsured? When there's a banking crisis, if you can get free insurance at the bank right next door because it happens to be JP Morgan Chase, you're going to just say, let's go next door. Now, you might be a little slow to do that because if you're a business, you probably got all kinds of structures set up with your bank that makes that more complicated than me going out and changing my checking account. You've got automatic payment systems, payroll services, various things that services banks might provide. They're going to slow you down a bit in that, but it's happening. And it was pointed out by, one of the senators, Lankford, just a week or so ago when he was talking to Janet Yellen saying, look, money's fleeing the banks.
And she said, the banks are perfectly sound.
Yeah, and she says that over and over. And, in my latest article about this inquisition that was nothing with the Senate and the FDIC head and the Fed head of regulations and one of the people in Treasury, one of the things I pointed out is what you hear in that, like a refrain in a song, is the banks are sound. The banks are fundamentally sound. You're not here to answer if the banks are fundamentally sound. You're here to answer why you didn't regulate this, you know? And there weren't that many senators that came down on them hard enough for the fact that they didn't regulate this. When, they would say, well, it was the bankers that were the problem. The bankers weren't paying attention. Well, we know that. That's obvious. Their bank wouldn't have gone bankrupt if they were paying attention. The point you're supposed to be here to answer is why you didn't do anything about it. So, and then they'd say, well, we need more powers. We need laws to do this. And then one of the senators read to them the laws that stated outright in multiple places that the Federal Reserve has the power to create anything it needs to regulate banks in the case of preventing a systemic crisis. They said, now you just told us in your earlier testimony today, this was a systemic situation. So you had the powers to do whatever you needed to put the rules in place, not, do whatever you need to in the whole world, but with banks to make sure that a systemic problem doesn't happen. And they answered it, well, but we didn't have those rules in place yet. Well, then put the rules in place and put them in place before you start raising interest, because you have to know, as the Federal Reserve, the opening question or statement you made is that as you're raising the interest on bonds, the value of these banks' reserves is going to go down. So they should have been watching for that from the very top. It would have been simple enough to look at every bank they have out there and say, what percentage do you have held in treasuries that are going to devalue? And then focus on those banks that have 70, 80% of their reserves in treasuries and say, you guys need to change now. A couple of months from now, we're going to start raising interest rates. So before we even do, start divesting yourself of those bonds, start liquidating them. Well, the value's still there. But they didn't do that. And you wonder, how did you not see that coming?
Well, there's the other issue of, there's a term called moral hazard.
Yeah.
Which people who went to school wouldn't be familiar with because they're not familiar with anything. But moral hazard relates to the concept that if I go to Atlantic City and gamble, and you tell me that if I lose my money, you're going to reimburse me, I have no incentive not to gamble. I can gamble for the entire week or month or whatever it is, and I don't have to be careful at all.
Mm-hmm.
When you tell people that the government is going to back you up, or the government agency is going to back you up, and you're not going to lose money, and not only did they do that, but they went beyond the $250,000 FDIC limit and issued a blanket bailout of everything and everybody, which of course they don't have the funds to do that.
Right.
In terms of the money that's actually sitting in FDIC reserves, it's not even close. It's even worse than Social Security, if that's possible. Our whole system is based on trust. How anybody could trust these cretins to babysit for their child, let alone it would be like hiring a pedophile to babysit for your child. It is beyond me how you could ever believe a word these people say. So comment on the moral hazard. Also comment on what Yellen and the mummy man Biden is saying about, the American people are not going to be hurt by this at all. They're not going to participate, and this is not a bailout. And it gets very tricky as to whether it is a bailout because of the bail-in laws they pass and because of other things such as, is it a loan or is it outright giving of money to these banks? And it gets very tricky. So perhaps you can comment on those issues.
Well, I think it's a lot less of a bailout than what we saw back in 2008, where they just gave tens of billions of dollars to banks to, or loaned it to them to help them through their own crises. I think one of the big moral hazards is they always go and make the big banks bigger, just like they did with this present situation where deposits are now fleeing to those banks because they've created a hazard for people who choose to bank with small banks by saying, we're not going to insure you as much as these. So by picking favorites, they create a different kind of hazard than a moral hazard. They create no moral hazard, no hazard of any kind for the people that bank with the big banks, and they retain the hazard that exists for the smaller banks. Now, part of the basis for a $250,000 limit is that if you got $1 million to put in a bank and you're a company, you probably have a CFO or something, and you have a certain amount of due diligence responsibility to research your bank and make sure that your money's going to be sound there as best you can. And you're limited on what you can do, of course, but you try to pick a good bank, and some companies put a lot of effort into that. But if you're just your average homeowner and you're banking 100,000, over the course of several years that you're saving away, you don't really have the wherewithal to do that research. So you're providing, some insurance for basic amounts so that the average guy who can't be researching banks and doesn't know how isn't going to get hurt because of bad banks. But it's intended to only bail out the occasional bad bank that falls from its own stupidity or greed. In this case, we've got a systemic problem created by the Fed because it's putting pressure on all banks, and that means the worst ones are going to pop first. And this moral hazard that you're talking about, we can take that at least as far back as 2008 and the bailouts that happened there. When I was writing about that at the time for the Hudson Valley Business Journal and a few other papers that I, syndicated my articles to, I was pointing out then that everybody was even talking then about how we're creating this moral hazard of we're not making these people responsible for this. So they're going to do it all over again. They're going to keep taking risks. And of course, that's what we saw they did as they piled in risk. That's what these bankers did that failed. They said, well, we could take the conservative approach and sell our bonds, and before they go down in value, but they would rather focus their time and their effort on making big yields and other things. So they didn't do that. They should have gone for, getting rid of those bonds.
It's an amazing thing, David, how, in my life, if I do business with somebody and they renege on their promise or their contractual obligations, I never, ever believe them again. Because once I catch you doing something dishonest, you have lost all credibility. It amazes me how these people do like a washing machine cycle, and they do the same thing over and over. It's like recycling garbage, except the garbage are the politicians and the whole Wall Street crowd. And yet the American people continue to believe these creeps. And it's like they think it's their mommy and their daddy. My mommy and my daddy would never do anything to hurt me. They're taking care of us. Yeah, they're taking care of you, all right, the way a mafia kingpin would take care of you. And what will it take to get these dimwits that call themselves citizens to wake up? Because one thing I can tell you, I've worked for politicians in my day. And, I probably also was involved in prostitution. It's the same thing. But point is, what's going to take them to realize that these people don't care about them at all? These people cannot be trusted. And you have to independently read blogs like yours that have no agenda. You have no agenda. I can read your blogs, your blog articles, as I do, and it takes work to read all your articles because you're writing constantly. And the volume of reading that I do is beyond human. And the people will not take the time to do their due diligence to protect themselves and their families. And then these same people will tell me, oh, my kids can't afford to buy a house. Oh, my food bill has tripled. Eggs cost $8 a dozen. And they cannot connect up the tumor with the underlying cancer, to coin a phrase.
Yeah, well, that's why I wrote my little book called Downtime. Why do we do the rinse and repeat cycles of boom and bust economies. Because why do we? Why do people never wake up? Why do we leave these people in charge? But I can't successfully convince anybody to change the system. You don't see any of these senators that were in this inquisition looking to change the system. Why? Because they know they want to repeat the boom and bust cycles. They wouldn't admit it, but it doesn't make a bit of difference if you're a Republican or a Democrat when it comes to the willingness and the desire to fund the government with massive amounts of debt. Now, some people think it does, but think it through. During Reagan, the federal deficit tripled. The budget exploded. Why? Because he cut taxes way back too much to where they lost revenue. And David Stockman, the architect of that, said you got to bring them back up. We went too low. Okay, so they did that, and they found, more or less the sweet spot where revenue did well, even with the tax cuts. But then he hugely expanded the military budget. So he created this massive deficit. And you go right through every president, Democrat, Republican, they've all done the same thing. That's why I say you've basically got two choices. You got the welfare party or the warfare party. They'll both spend on deficits till you hit the sky and go beyond. Because it's just a question of what they're willing to spend it on. So, people say, well, this is Biden inflation we have. Well, it's also Trump inflation. I started writing this inflation was coming during Trump's last term when we had all the COVID lockdowns. That happened while Trump was president. We closed down the whole economy, and we started creating these massive programs to bail out companies like his, and millions of dollars went into his company and many others to cover payrolls so we could pay people while we forced them to not work. Okay, well, that's the recipe for super high inflation. If you have too much money chasing too few goods, if the government mandates that goods and services are going to be shut down, as happened in that year of the COVID lockdowns, while Trump was still president, then of course you're going to have too few goods and too few services because you're locking out production. But you're creating these hugely expensive programs, the stimulus checks, the extra, the doubled unemployment checks, and the massive amounts of money that went to companies to pay people that weren't working. And who knows, how many banks profited in that chain. You do all that, you totally blow the government deficit up, and therefore the debt that, is that deficit compounded. And people aren't producing. So now you got all this money that you're funneling into people that aren't producing through paycheck protections, doubled unemployment benefits, and stimulus checks, and you got this huge reduction in production. So there's too few goods and too much money. Bam, you've got critical mass for high inflation. And so as soon as I saw those two things coming together, for years I'd said we're not going to have high inflation from what the Fed's doing, and everybody else is saying, oh, we're going to have hyperinflation because the Fed's printing billions and billions and trillions of dollars. And I said no, because it's all staying in the banks, and money only creates inflation where money circulates. So it's staying in financial circles, it's creating inflation in bond prices, it's creating inflation in the value of the things they invest in, stocks, artworks, whatever. It's not creating consumer inflation. But now you've got policy under the Trump administration that continued under the Biden administration. I'm not picking Trump here because we're going to go to Biden. But I'm just saying you've got the same thing, whether it's, at that time, at one point you had Republicans fully in charge of both sides of Congress and the president, and they were still pushing up these massive deficits and debts. Well, the point of all that is to say now you're pumping all that money into consumers and they don't have products to buy. So yes, they're going to bid up prices. You don't bid up prices just because you have more money. Nobody does that. Nobody says, hey, I got $1 million. I'm going to go pay $5 for an apple when the guy next door is selling the same apple for $1. I don't care how rich you are. You don't do that. But when you have all that money and then apples aren't available because everybody's working the gold mine or whatever, so they're not producing apples, all of a sudden an apple becomes worth $5, like in a gold town, because nobody's dealing with the apples. So there's a limited amount of supply. So now you use that money to bid it up. Okay, so that's what got all this started. Biden continued the same kinds of programs, and he mandated further shortages. Those lockdowns went away, but then he fired me. He fired a lot of other people because he said, if you don't take this vaccine, you're the one causing this disease. you're the reason for the plague, you're fired. So the school I worked for fired me because I wouldn't get the vaccine, and lots of people got fired. And so now again, you're getting shortages in services and shortages in production, because you're forcing people to not work. So we got, both parties doing this. Neither one of them is going to go after the Federal Reserve. This is the point I'm coming to.
They grovel. They go, "Thank you, Mr. Chairman, for your service." It's like,
exactly.
how?
Because we have to have these low interests if we're going to keep spending all this money with government debt, whether we're sending it to welfare stimulus programs that make us look great because, we're like Biden's big infrastructure stuff. What do we need stimulus for when we don't have enough people to work the jobs that are already there? Creating more jobs, that just makes that disparity worse. So they need that low interest money. And they're not going to really get after these guys for not raising rates faster. I mean, they want to keep the rates down as much as they can, and they're not going to push the regulators too hard on this.
You remember what the socialist Trump said to the Fed? He said, "We want the money. Give us the money." He was talking about negative interest rates. Remember that? We want that money. We want that. Yeah, we want.
There you go. It's both parties. We want those interest rates down to stimulate the economy. Well, you know what? I said even clear back in the days of Reagan and the economy boomed, that it's amazing how much fun you can have when nobody's paying for it. If you're going to go out and buy all this stuff on the company credit card, then yeah, you can have a booming economy because you're saying our grandkids are going to pay for it. And yeah, you can have a huge military because you're saying our grandkids are going to pay for it. And I say, hey, if you want to say we're strong, we have a big military, then you tax people now to make them pay for it, or don't do that big military and just admit you can't afford it. Don't do it on credit. Same thing with welfare programs. Don't pretend you're generous because you're giving away money. No, you're not. You're giving away your grandkids' money. If you want to create those programs, then you tax people now to pay for it. And if people don't want to be taxed for that, that's fine. I understand that completely. Then don't do it.
You've got some background in real estate. So in the last few minutes before we tell people how to get a hold of your work, tell us where you see the real estate, because I see it as an even bigger bubble than the one we had in 2008. So give us a little bit of your assessment of residential and commercial real estate.
Well, I think the worst problems are going to happen in commercial real estate, because last time the big difference we had, and this is where I got started on writing on economics, was real estate, because I was working as a property manager at a resort in Hawaii, and I had a conversation with the real estate guy there, and I told him the whole real estate market is going to crash. It was already starting to go down in Hawaii. I said this is going to be a disaster, and the reason was because when I looked at, I was asking myself, how are these people affording all these $1 million houses in Hawaii? How's this happening and everywhere else? And I realized, well, it's because of these adjustable rate mortgages. They can get it at this really low interest, and then 5 years later, when it goes up to realistic interest, then they can just sell the house. They can flip it and make more money and do it all over again because of the equity that they built into it, because the prices keep going up. I said, what happens when the prices stop going up as they had and they start going down as they had? Now that 5-year term comes up and your property's worth more, you can't flip it, the interest rates go up, you can't pay for it, you're going to default. Well, we didn't do all of those time bombs this time that we did then. We had a lot of adjustable rate mortgages, and I referred to them as time bombs, and that's when I started writing about this, and then it blew up. The real estate agent laughed at me. He thought I was an idiot, and that that's partly what got me fueled on all of this. I thought, you guys really can't see it. You're just you believe real estate always goes up. So that time commercial real estate was going to go down because it was way overpriced, as it is today. It's more overpriced today, but we had those ticking time bombs going, which made that worse probably than it is today. But we're still, we've seen like the Seattle market and San Francisco have come down 16% since their peak less than a year ago. That's a lot of decline in a year. So you're still going to see problems with defaults. Maybe it won't be the big blow up that it was. But what is blowing up, as you mentioned at the beginning, Blackstone, companies like this that are in commercial real estate. You've got already you had a retail apocalypse going where people were closing retail stores partly because of electronic buying, you know, Amazon and stuff. And just, you know, business was down. And so those spaces were having troubles paying their bills and paying their mortgages. And now you've got office space that really had problems because of the COVID lockdowns. And while a lot of those workers are coming back, it's not in the degree that it was. So businesses are downscaling and they don't need that space. So you've got companies that went out, you know, and started building projects that take a couple of years to build, started them just before COVID hit, and now there's no way they're going to lease those out. You can't even lease out the available spaces from the projects that already existed.
Okay, we've got 2 minutes, and in
Right.
the time, let's see if you can tell the people how to get your work. And I am also a subscriber. I think you call them a patron or a Patreon. I'm one of them, and it's very valuable. I'm vouching for David's work. It's very valuable for me. And also, if you have the time, comment on the demographics of the fact that most people don't have a lot of savings. Most of their wealth is in their house. And when they see the market coming down, will they rush to sell their house and cause a real oversupply of inventory at that point?
Mm-hmm. I don't know on that question. What they're going to do is they see the value. They might just hunker down and say, you know what, this is going down, but I own my house. I can afford my payments. And so long as I can, I'm just going to freeze, right? I mean, that's what I'm going to do. We just bought a house. We wound up having to buy in a situation where we had to, and the, you know, right as things were going crazy, high priced. And so, but we got it, and we're okay on it. And we've got our mortgage payment down to $1,000 less than it was.
Okay, have to interrupt you. Tell everybody how they get stuff. You only have a minute.
All right. So go to THEGREATRECESSION.INFO. That's my blog. You can find articles there. Most of them are for free. I write special articles for my patrons. You know, if I need the contributions. I'm unemployed. By choice in a way. I mean, I was fired because of Biden.